Hey, everybody, this is Bob Goodwin, president of Career Club, and welcome to another episode of Career Club Live, our weekly podcast where we interview industry experts. If you're not familiar with Career Club, please check us out at career.club, where we're using proven sales and marketing techniques to help people find careers that matter to them. If you've been affected by a layoff, whether you're an employer or an affected employee, please check us out. We've developed some new tools called Next Placement to help people advance in their careers and to help companies help the employees that are affected by these in a more human-centric way. So again, check out Next Placement at career.club. So with that, I'd like to introduce our guest today. I'm very pleased to introduce Karen Short. Karen is a managing director at Credit Suisse, covering food, hardlines, and broadline retailers like Walmart, Target, Costco, Kroger, Home Depot, Dollar General, and a number of other major public retailers. Karen's been ranked number 1 or number 2 by Institutional Investor for the retail sector since 2013. And with that, Karen, welcome.
Thanks for having me. Really happy to be here and happy New Year, everyone.
No, it's great to have you. So we met when you were at Barclays and now you're at Credit Suisse, and it's just really great to reconnect with you.
Yeah, thanks.
Yeah. So as is our tradition here, Karen, we like to get to know our guests a little bit and see the real person behind the title. So just a couple quick questions. Where were you born and raised?
I was born in Toronto. I lived in Toronto for through high school. I'm in more or less college. Moved to Vancouver and then moved to Seattle for a role in energy trading. So that was my earlier career, was power and gas trading, and managed to get my green card within 3 months. And as soon as I got my green card, I applied to business school and came to Columbia Business School in New York. And here we are in New York, many years later.
No, that is great. And so you mentioned Columbia, so that's where you went to B-school. A little bit just about your family, Karen.
Well, my family's still in Victoria, Canada, or west coast of Canada. Mm-hmm. As I mentioned, I'm obviously from Canada, and I became a U.S. citizen on Flag Day this year, and many people have asked me why it took so long, and I can get into that a little strangely, but it was basically a lawyer put the fear in me that, like, if anything happened that was, suspect, the U.S. could deport me. And I suddenly realized that even though I'm married to a U.S. citizen, I'm basically just a temporary person here if anything came up that would put me at risk. So I immediately applied for my citizenship. So I'm now a citizen, and my whole family is still Canadian.
Well, and Flag Day, how cool is that? That's awesome.
It was a pretty moving ceremony. I mean, it really, people try so hard and so long to become citizens, and there were a lot of tears and photos, and it was very moving.
That's very cool. As obviously an American citizen, I think that it's very easy to take it for granted, and ceremonies like that and stories like yours are very cool to hear. That's like, no, not everybody gets to do this. This is something special. So on behalf of all the United States, welcome.
Thank you.
You mentioned energy trading at the beginning of your career. Do you mind just painting a little bit of a picture of your career arc?
Yeah. So so basically energy trading, and we're talking operations and operating pipelines, but also trading power and gas. So I was a little more like operations management, but also a trader of power and gas. I like the trading side of it, and I like the kind of sales side of it, because I was generally more the seller of the product and the seller of the pipeline. And so I, obviously established a very wide network of clients at that time. Enron was certainly among them, I can tell you that. But, it's a skill set, because you're doing something operational and your sales and trading that actually ended up being very transferable to what I currently do, which is obviously being an equity research analyst at Credit Suisse. And while, it may sound strange, but the skill set is, financial modeling operations, but part of your role as an equity research analyst is absolutely selling ideas. And so as a power and gas trader in Seattle, as soon as I got my green card, I was a free agent basically. And as soon as I got into, and I applied to business school immediately and went to Columbia and went into a financial kind of consulting role after business school. And I had a lot of options with respect to job offers. I had banking energy options. I had consulting energy offers. I had sales and trading offers. I had pure financial role offers. The role I ultimately picked was to do financial consulting for a company that it isn't necessarily here anymore, but it was called Stern Stewart, and it was very much ROIC. It's called EVA. Well, they coined the term EVA. Mm-hmm. And what I liked about it was that I knew it wouldn't close doors, basically, because it was so financially intense and also consulting. And then very quickly, I kind of got a knock on the door from many, many investment banks, the HR people that were involved directly with equity research. And I started interviewing directly with analysts in equity research because I think it's so important to pick who your boss is and your mentor is going to be. And when I was interviewing in business school at the time, you couldn't interview directly with an analyst. And after the dust settled, post me already starting this new role, I actually got the opportunity to interview with very specific analysts. And at that time, anything technology related, like cell phone towers, et cetera, those were like the fun places to be. Yeah. And I interviewed with a woman who covered food and drug retailers. And at the time I kind of, my thought process was, she really cared about me because she wanted to meet me many times, including meeting me for a drink just to get to know me. Mm-hmm. But B, nobody, you're always going to have an opinion of the grocery store that you go to or the drugstore that you go to. So consciously, I said, I don't really care about cell phone towers, frankly, but I do have an opinion of a grocery store, and I didn't live in New York or had not lived in New York for a very long time, or for a long time at that point. I'd only been in New York for 2 years, but I knew what it was like to not live in New York and know which grocery stores I went out of my way to go to. And so I accepted the job with her. And then, there were various iterations of me getting promoted to become senior analyst as opposed to associate. Back in 2016, she retired from Barclays, and Barclays hired me to replace her. And I actually even had her phone number. So for 4 or 6 years, I would get calls for her.
Oh, there you go. There you go.
And then recently made the move to Credit Suisse.
Well, we'll talk more career stuff in a bit, but you've already kind of telegraphed some important things, particularly interviewing your boss and that they care about you and your career. The other thing I'll say just really quickly that I empathize with is, having been in kind of the consumer goods ecosystem for the last 20 years, I like it too because it's stuff that everybody can relate to. As you said, we all go to the store, we all buy stuff, and it's different than, something that's a little bit more esoteric, like energy options or electron microscopes. So I relate to what you're saying. What do we find you doing, Karen, when you're not at work, being a top-rated analyst on the street?
Well, I definitely work out a lot. I play tennis. I do yoga. I golf occasionally, reluctantly with my husband. I try to travel to interesting places. One unfortunate coincidence with the Flag Day swearing in was that I had to hand my green card to you have to hand it back to get your citizenship or your naturalization certificate, which means you can't travel anywhere until you get your passport. So my swearing in and, relinquishment of my green card coincided with my 3 months of my garden leave. So I would have liked to have traveled a lot more in those 3 months, but I have it now. So now I can.
There you go. Well, thank goodness. That's funny. I know that you're very into health and wellness and things like that. So I'm not surprised to hear about some of your activities. So with that, let's kind of bridge into today's topic, which is sort of all things retail, and maybe a double click on holiday since that's recently behind us. But as you've got to Credit Suisse and started initiating coverage on your retailer universe, the names that you cover, what is your overall view of the retail landscape, particularly as we step into 2023?
Yeah, so maybe just to set the stage. So I cover 22 retailers. It's about 1.6. I'll have to get you the exact number of the market cap coverage, but it's all essential. And I don't want to use that word because I don't ever want to hear it again, but it's pretty much all essential retailers. So every retailer that I cover was open during the entire pandemic. And as Bob listed, the names that highlighted some of the names, but they, it does include Home Depot, Lowe's. You did mention Home Depot. So I initiated coverage on December 19th, and my view was very cautious because I think 4Q is just going to be messy in general, and guidance is going to be a little messy. So I could have sat twiddling my thumbs until March when every retailer has finished reporting, but that's not constructive for anyone. So I'm very neutral right now on a lot of names, with the idea that I would like to get more constructive once we get some of these data points out of the way. The caveat would be it depends how they guide on 2023. And what I'm a little concerned about right now is that December was probably not great on sales through to actual December 25th. I think things past that, once we got past the polar vortex, improved decently. And then January so far is off to an okay start. So the question is whether or not my companies under coverage are emboldened to guide a little too aggressively. And I think there's a decent probability that that's the case. So I am very neutral with a bias to get more constructive, again, because I cover a list of what I would consider best-in-class retailers. I just think right now it's premature.
So, obviously there's a lot of things that are acting on consumers these days, the shoppers at all these retailers in your coverage. What's sort of your overall take on kind of like, it's probably two questions in one, the sentiment of consumers and the capacity of consumers?
Well, I really think you have to make it a bottoms up conversation, because the lower end consumer, and I guess we can all debate what cutoff on household income you determine to make a consumer lower end, but there are not a lot of savings that are still there. And obviously it has been one big 3-year party with all the stimulus for many consumers and across all income spectrums, or most income spectrums. And typically a lower end consumer doesn't save. And a lower end consumer doesn't actually always even have a bank account. So like all the bank commentary on savings accounts and checking accounts isn't really super relevant for a lower end consumer. But I think broadly speaking, what matters is employment levels or unemployment, and going into potentially a recession when employment levels are still so high probably helps kind of lessen the blow, if there is going to be one, that is. On top, but the flip side is inflation is very high, especially in food. There does appear to be a lot of noise on electronic benefits, as in foods like food stamps or SNAP. Those are coming down meaningfully. they did start coming down in October 1 of 22, but there's emergency allotments and some other components of that will start trickling off imminently. So the real question is does a cohort of the consumer kind of freeze? And I think it's quite possible that they do. And so I'm cognizant of that. And that may not affect my names as much as it would affect a pure discretionary retailer. Mm-hmm. So because you're still, within the food complex, you're still buying food. You may have to trade around. So you may not buy the tier 1 brands. You may have to buy tier 2 brands. You may buy private label, but you're probably cutting back on discretionary.
Yep.
Because you're not being subsidized in your life as much. So those are the things that I will start happening, before a lot of these companies start reporting. So it's definitely something that needs to be watched. But I'm a little more glass half empty than most, just in terms of how that consumer is going to hold up. Yeah.
And so, and I don't know what your ability to talk about certain names is on a call like this, but, it's pretty common that people would talk about Walmart, definitely skews more towards food and non-discretionary, and somebody like Target, skews more discretionary in their merchandising mix. So you would see that as underlying factors that would drive a retailer's performance?
Absolutely. Well, I know Target is perceived to be more discretionary, but actually the reality is when you consider food and beverage and house or essentials and beauty, they're actually 48% of sales, those two, whereas Walmart for, let's just call it food, is 50. So, I mean, there's actually not a lot of difference, but I think, Walmart is certainly defensive in this environment. And, they noted that they had a trade in. So from higher income consumers, they've seen trading into their format, and they're certainly in a much better position to retain those customers because their execution is so much stronger than it was in, call it 08, 09, from just an experience perspective. 08, 09, you went to Walmart because you had no choice. And I just don't think that's the consumer perception of Walmart today. But the reality is that they still skew to a lower income demographic, and they didn't perform so well in the early parts of the pandemic, partly because of inventory, self-inflicted inventory issues, big box not being super quote unquote safe. But consumers were flush with cash, so they didn't mind going to a higher end conventional grocer because they had excess cash. Target's a little different, and they certainly got the trade in from the lower income demographic. And they, Dollar General would talk about the fact that their customer surveys showed that the Dollar General customer had traded up to Target. And so, Target is struggling a little bit for other self-inflicted reasons today. But the real question is, did that customer just have to trade back into Dollar General? And that's the reason why there's some softness and squishiness at Target, because they're kind of just viewed as Target. And the perception is that they're still Target, and that even though their price points are very close to Walmart, at least in essential food products, the perception is they're expensive, even if that's not the reality.
Yeah. So you're getting at all these things, but just to kind of make sure that we don't miss anything, we're talking about, government checks, SNAP, inflation, particularly vis-a-vis wage gains and how inflation's outpacing that. These factors and maybe other ones, do you see them especially benefiting or specifically hurting retailers and or channels that you cover?
I do, because I think, as you point out, inflation is outpacing wage gains. So net, you're constrained. And that's a statement for most demographics, not just low middle income. It can play out both ways, because you can have a scenario where you get trade into the lower price point formats. So trade into Dollar General, I trade into Family Dollar, trade into grocery outlet. Those things can certainly play out, but a Dollar General still has discretionary product in their store. So are you not, you're not buying discretionary because you have no choice, and you're trading in for the non-discretionary. I think those are the main dynamics. It's a slightly different dynamic for home improvement, like Home Depot, Lowe's, and Floor and Decor. But I think at the end of the day, Walmart will probably continue to benefit from trade in.
Yeah.
Target, I don't know. They need to change their messaging, and I don't know how you do that, because it just seems from the last several quarters that it would lead me to believe that they have not justifiably not been able to retain the consumer that traded into them, because those customers were only at Target because they had stimulus checks.
Yeah. And well, you kind of alluded to, I think a lot of retailers also suffered from bloated inventory, and they got product late that all of a sudden wasn't desired anymore, and had to take a bunch of markdowns on that stuff just to get it through the system. And again, probably something that didn't help a lot of your retailers. But one of the things, I guess, kind of being forward facing then, is as you think about the different actions that retailers can take to position themselves to either ride out or potentially thrive in the economic downturn. You had alluded to private label earlier. You were talking some about pricing. Do you want to riff on that for a minute?
Yeah, sure. Sorry, one thing I was just going to say, as it relates to the supply chain, the supply chain bottleneck kind of broke, I guess. There are still supply chain issues, but inventory hit. Well, let's take a step back. Retailers ordered for 22, thinking 22 is going to be exactly the same as 21. So they all ordered inventory, and then everything just kind of landed in April, right as gas prices started climbing and as the consumer froze. So you had all this excess inventory. Consumers completely froze with the peak of gas prices, and obviously inflation in food was a problem. And so it was kind of a triple whammy. So here we are kind of working through this excess inventory. Gas prices are obviously not as much of a problem, but I think they have to be watched the most, because say Five Below, they could see the consumer freezing, and a third of their customers are household income is less than 50,000. So again, it's very much a bottoms up kind of conversation. So it depends on what retailers you're talking about, but Walmart is absolutely aggressively not pushing, but they're not raising prices on private label, key value items and key velocity items. So if they're doing that, there's a ripple effect to other retailers or conventional retailers that have to potentially follow suit. I think the key thing is it's always, what is Walmart doing? And I don't think that they're trying to lower prices other than in these, or keep prices low, other than in these key value item categories. But I think we've kind of seen the last round of price increases from the vendors in terms of the CPG. So that's played out. And by the time you're in the second half of 23, I don't think that Walmart is going to be accepting price increases. And if they're not accepting them, others are not going to be able to accept them. And it just has, like I said, a ripple effect. And it may be that Walmart decides, if there is slowdown, that they do take strategic pricing actions. I wouldn't rule it out. We're not really seeing it yet, but it may come to that.
So speaking of, Walmart is the benchmark and people tend to follow suit. I know that you've got a point of view on price gaps and what you're observing with price gaps. How's that changed over the past several months?
Well, interestingly, we just published a report. So since 2018, I've been publishing price gaps. This is a food comment. I've been publishing price gaps to, in every market that I check, I publish price gaps: Walmart to Target to Amazon to Kroger to Albertsons, and to Target, if I didn't mention that. Target and Amazon and Walmart have always been neck and neck during the pandemic. And that remained the case during this entire last 3 years, 2 years, 3 years, well, 3. The conventionals absolutely, and the gap just spiked. I mean, because conventional grocers are high-low operators, and they just ripped off the low. Like there just weren't any promotions. So, and Target and Walmart are EDLP, so everyday low price. They don't change their pricing on the shelves. And so you saw those gaps widen meaningfully. I'm starting to see them come in a little bit. But what's actually really interesting to me, and this is a very small sample size, but Target seems to be inching, not small sample size, it's a small number of cities. Target seems to be inching up on price. And it's something that I need to watch, because if they have always been like 4-ish%, the last check, they were like 13. And again, this is a food comment. So it bears watching. And the conventionals are starting to kind of inch down a little bit.
I was at a asset management meeting back in early December, I think it was. So a lot of the big people would probably be like your clients, actually. Everybody's super concerned about private labels. So, they were going to go to an analyst meeting for a major CPG manufacturer. And so kind of looking at it from the other side of the equation with the brands, they were getting really nervous about private label, one from a pricing perspective, but maybe more importantly from a value perspective, because the quality's really improved with private label. And how do you see private label being, maybe one of the assets and a arrow in the quiver of your retailers?
I mean, absolutely. And I think the point is that the retailers know what their input costs are, because they're doing their own private label manufacturing. So if you have your own data, you're pushing back on vendors on what you think is acceptable from a price increase perspective. But more importantly, the supply chain bottlenecks are starting to ease a little bit. And so private label, there wasn't a role for private label over the last 3 years because consumers were not price sensitive. But B, they couldn't execute and couldn't get the product to the shelf anyway because of the, how fragmented the industry is on product manufacturing, and branded was the focus for anything supply chain related. So now you're starting to see that emerge as a much stronger factor in consumers' buying decisions. So, Costco, I think, called it out in terms of the inching up. I want to say it was like 100 basis points. They didn't give a big number, but 100 basis points is a pretty big move.
For a retailer, really big.
Yeah. So, I mean, again, as long as, everyone knows Kirkland is a global best-in-class brand. So it's a brand in its own right. But if you saw that inch up 100 basis points in a quarter, that's a meaningful move.
Yeah. Maybe more strategically, I suspect a lot of your retailers are taking a bit of a wait and see, perspective on doing capital investments, whether that's store openings, remodels, maybe technology investment. Either what are you seeing, or what would you hope that they're doing now?
Yeah, so many of my retailers are kind of in harvest mode in terms of their store base, so not necessarily growth mode. The harvest mode's call it sweat the assets and just drive greater productivity through your 4 walls of your store, and buy online, pick up in store, and e-commerce, whatever it may be. So tech is certainly not coming down as an investment. Store openings is a little squishy. I would certainly, again, there are specific companies that are growth stories. So Five Below is a growth story. Floor & Decor is a growth story. They're not going to slow down on that, because the second you turn off the spigot, you're just delaying, getting back into the game in terms of getting the locations. So they're not slowing down. But I mean, I would argue that for the vast majority of my space, nobody should be opening stores. I mean, I'm not saying that for Floor & Decor and Five Below at all, but there should be, I mean, other than remodels and maintenance CapEx within your stores, there should be no investing in any unit growth. And that's, I mean, again, food, we're overstored. So it's definitely a food retail comment.
You mentioned e-com and, curbside and stuff like that. Do you think, because if we go back 3 years ago, beginning of the pandemic, that was a huge part of the conversation of click and collect and all those, kinds of things. Do you think the industry's gotten to parity on at least that aspect of technology, or there's still leaders and laggards?
It really depends on the retailer. Like any retailer that's relying on Instacart is a laggard because you're giving, or a third party, you're giving them the data. And, maybe you come to an agreement where you share the data, but you're giving some other third party data that you should be keeping in-house. So many have not, because they are relying on third party providers, at least for some portion of it. So either way, the third party is getting the data. So I do think that there need to be more technology investments, but I think that there's just a mindset that it's not necessary because we have, costs with these third parties has come down. And, the cost to build in terms of a distribution center has certainly gone up meaningfully. So if you talked about like early days with Instacart, if a retailer's decision was that they needed to have the same prices on Instacart as they did in their store, then they were paying Instacart a fee. I'm going to go with around 8%, but I mean, it's been anywhere from 8 to 15%, depending on the retailer. DoorDash has compressed that. So DoorDash, to get more share, is probably asking for like a 3 to 4% markup. So there's certainly a dynamic of like, if you're doing a 3 to 4% markup and you're not building a single facility for the fulfillment, that may not be a bad decision. Just because capital spend on FCs, fulfillment centers, is much, much, much higher than it would have been pre-pandemic. Mm-hmm. But at the same time, you still need to own the customer. Then the more you siphon it off because you're being, conscious of capital, it's going to come back to bite you at a certain point in time.
Can we take a quick detour then, and because I think this relates to owning the customer data, which is retail media networks. Mm-hmm. I talk to a lot of my friends who are in the CPG industry, the data and analytics industries, and that's like really a hot topic. And they think that I guess Amazon's the number 3 after Google and Facebook now for advertising dollars. And you've got other major retailers, like some of the names we've already mentioned, who are really getting very serious about their retail media networks. What's sort of your take on that from a competitiveness perspective and maybe from a profitability perspective?
Yeah. So, I mean, in the early stage of retailers trying to go after these dollars, it was very clear. Well, it was very consistent that the CPG companies look at advertising in a different bucket than they look at vendor promotions.
Yes.
But when, that was when 2 or 3, whatever number of retail, a handful or, a small fraction of retailers were trying to get more of these dollars allocated to them. And my pushback on all of that was, you look at a Google, how many eyeballs a Google has, how many eyeballs an Amazon has, how many eyeballs, whoever you want to add on to the list has. I also know exactly how many eyeballs a conventional grocer has for online. It's not about the number of households that shop in their stores. It's the number of households that are shopping online. So there are many retailers that have made big promises on what they think those dollars can look like. Mm-hmm. And I've always thought it was a fallacy because it's not about how many households you have in your 4 walls. It's how many are using you on an app or online in general. And now, fast forward, every retailer is talking about this.
That's right.
So as every retailer talks about getting their fair share of the ad dollars, it just gets arbitraged away as a benefit, because at the end of the day, they're just going to end up with the same share of the pie that they had on call it vendor dollars or whatever else you want to, you want to make the analogy for. So I think it's a great headline, but I just think it's going to get arbitraged away and or reinvested in the actual four-wall business. And it may be that the vendors can do more directly with the retailers as opposed to using, agencies for the spend. But if everyone's chasing the same thing, it's just not going to play out to be this big boon for the retail industry, in my opinion.
No, and it makes sense. I mean, it's like it's going to dilute by definition because everybody's trying to play in the same thing, fighting for the same dollar.
Right.
So that was, I'm really glad that you had a strong opinion on that. It's a hot topic. Speaking of hot topics, holiday 2022. I read in one of your notes that there's just a very unusual level of volatility. And I think we've talked about some of the factors that created that volatility. But, how would you kind of categorize holiday 22, at least what your expectations are versus prior years?
Well, I mean, at this point, unfortunately, we're still doing like 2-year, 3-year compounded CAGRs, comparing everything relative to even including 19. I mean, so holiday 22, you still have to do that because you have so much movement year over year from, pre-pandemic to hopefully what is the end. But no, I mean, I think holiday consumers, I believe consumers are going to prove to be more constrained and or there are more investments that needed to be made to actually generate the sales. I mean, weather did not help leading up to December 25th, but most data points show that it rebounded after December 25th and has kind of held in there in January so far. And weather has been more cooperative in most parts of the country. And that's why I was saying my concern is that if holiday and 4Q ended up being okay or relatively okay, does that embolden management teams to extrapolate that for the full year 23 when they guide? And I'm like I said, I'm a little more glass half empty on the consumer. And so that is something I'm watching out for, because I don't think you can extrapolate January to what and how the consumer is going to be feeling in June. Yep. And, obviously I'm not a top-down analyst, but I'm a very much bottoms up, and so that comment is a broad sweeping statement, but my gut is that it's, consumers will fizzle out.
So Best Buy's in your coverage. Consumer electronics are a really big gift giving category, right? TVs, computers, phones, all that kind of stuff. And then clearly Walmart, Target, Costco, maybe some other names in your list also, are pretty big participants in those categories. Do you think that the kind of muted demand for consumer electronics is going to be a pretty heavy factor in how some of these retailers do for holiday?
I absolutely do. And I mean, yes, absolutely. It's Target. It's, it is Costco to a lesser extent. I mean, we get Costco sales, so there shouldn't be any surprises there. It is Walmart, but also to a lesser extent. But I think the bigger issue going forward, and there are data from certain specific companies have reported laptop sales, have fallen off a cliff. So, that's clearly being felt already. But the bigger problem for, say, a Best Buy is there isn't any innovation. And that came out of Consumer Electronics Show in Vegas. And the lack of innovation is definitely a function of lack of funding, because these, innovators, I guess, or disruptors had product that was definitely viable this is a year ago in January 22. So they had something that was viable, and then they couldn't get the parts, so they couldn't manufacture it. And now they run out of funding and they can't get the funding. So that's a smaller vendor comment, but even the larger vendors are not, accelerating the innovation cycle yet because they're not super confident that they can actually get the products to market. And so it's a large vendor and small vendor problem. And Best Buy is definitely reliant on the innovation cycle. And it can't just be a new Apple phone that has, a different charging device. It has to be a lot more involved than that. So we'll see. But I would say for Best Buy in particular, other retailers that they kind of indirectly compete with, they've kind of cleared through their inventory. So 4Q could be much more promotional than it needed to be, but 23 could be, at least early parts of 23 could be less.
Yeah, that's a great call out on innovation. And it's actually been an issue for them for a long time. They benefited from the pandemic because, particularly in computers, because a lot of demand got pulled forward, right? And school at home, work from home, and devices, like you say, well, a new charging system, who cares?
Right.
And they really do need, some of their key manufacturers to come up with something that people actually want to buy and will go out of their way to buy. And I think that you marry that with what we talked about earlier with the economic environment. And it's like, I probably don't need that new phone right now. This one works pretty well as is. So any other factors acting on holiday that, you're expecting to see as your retailers start to report?
I think you're probably going to see a scenario where sales maybe end up being a little better than expected, but there may be less flow through because to earnings, just because the cost to serve keeps increasing. So, and that's the big debate is like, what's a sustainable margin structure? If you can retain the sales base that you've gained, and again, because all of my retailers are essential, their overall average unit volume is significantly higher. What does that mean for your operating margin? And I have, I'm well below on some names in terms of my operating margin, even though my sales number may not be much different than some of my competitors, but I am lower on the operating margin because I just think the cost to serve has gone up. And that's just a theme that's not going away. I mean, you're not taking wages back.
I'm sorry, can you explain what you mean by cost to serve?
Well, your labor costs have gone up. If you rent or if you're a leasing retailer, your leases are going up. And so even though you have a higher sales base per store, every single portion of executing within those four walls has gone up. And, the complexity of buy online, pick up in store. I could probably come up with a lot of, your distribution costs have gone up, although those are obviously going to come down in 23, but you can't just assume because you have a higher sales base that your margin structure is permanently embedded at a higher level. And that's basically what we're kind of seeing now.
So this has been awesome. I want to pivot because we're a career club and I want to talk a little bit about career stuff for a second. Any other kind of final thoughts as we tie a bow on just Karen's overall view of retail?
No, I do think that, the trading around and trading in and out of different retailers just has to be watched. Consumers are cutting back, may start to cut back. They're not yet, but consumers may start to cut back on, on travel, on, airlines, hotels. Like, do you start cutting back on eating out? We'll see how it plays out. A Five Below is very adamant that they're a needs-based retailer, but I would argue that, I love Five Below, but I don't know that anyone needs anything in a Five Below store. So during the pandemic, parents were definitely giving their kids extra dollars allocated to their kids just to make sure they were not miserable at home for 2 years. So I think that dynamic needs to be watched. I do think there's other certain things like I've had debates with investors about the sustainability of, pet sales in general. And people aren't, it's no different from your kids. You're going to feed your kids. You're going to feed your pets. I would hope. So, I think it's kind of a category by category statement more than anything.
Yeah, just on pet real quick. Again, that's something that benefited, air quote, benefited from the pandemic, that maybe has seen it spike. And look, it created, increased demand on an ongoing basis, to your point about like food and other things. But, I don't know that that's going to be a ongoing big driver, at least from another surge. So moving on to like career stuff. I always think this is a fun question. What advice would you give to your 28-year-old self with the benefit of hindsight?
So, I didn't have this at all, but I think as a 28-year-old, there should be no entitlement in your attitude with respect to career opportunities. And there has probably been a creep of entitlement over the last 3 years that may dissipate a little bit. But, people want to hire individuals who are hungry and willing to work. And it's not about being in the office. I personally don't care if my associates are in the office or not. I know if they're doing their job and I know if they're not. So I think attitude is really important. I would definitely say always make decisions that open doors and don't close them. So you kind of always have to play through, if I were to take this, like, what's my next option? If this doesn't work, where do I go from here? I would say, you need to find somebody who cares about you as an individual. And so back to my post just graduation self, I did have offers from people who met me for like 30 minutes and offered me a job. And I'm like, you don't even know me. And again, this is not an entitled comment, but like, how do you know if you're going to make a decision that quickly, do you have any idea who I am? And so what does that mean in terms of how you're going to actually treat me when I'm actually working for you? So those are the key things I would point to. Yeah.
Having been around, the equity analyst world for a little bit, you guys work your tails off. There is no entitlement in that. That is like, it's intense work.
Well, it's also, you need to gauge whether and this is a unique role because three people are tethered to me. So it's about, me being respectful to them. And I don't bother my associates on a weekend. Like, there may be a weekend here and there where there's something that just has to get done. But for the most part, it's Monday to Friday and, everyone puts their heads down and works hard and we all communicate and, no one works in a bubble. And so it's about communication and it's about respect.
Well, one of the things that you said too that I think is really important, and I'm finding this at Career Club too with my own associates, is my teammates here, is that it's not about the hours, it's not about the location, it's about, for me, two things. You mentioned both of them. Attitude. I want people who really are interested in what we're doing here, right, and care about what we do. You're interested in retailers. That's something that you're genuinely interested in. And then it's about performance. If you got your work done at 2 a.m. because that fits your lifestyle and that's what you like, then cool. It's about accountability to getting the work done. When and where it gets done, I am way less married to. I care about that you care about what we do and that the work gets done on time and with excellence.
Yeah. And I think, I know some of my peers, need to have their associates like right in front of their offices because they need to track what they're doing. Like, I don't want to track what they're doing. I know if they're doing their job and I know if they're performing at a high level. And as you said, I mean, there are times when 2 a.m. isn't going to work because I have to edit something, but I don't care. I don't care. You either get it done or you don't.
And any other, because I love your comments, any other career advice that you would offer to somebody who might be listening to this that's been important for you?
Well, I mean, I think that it's very important to be proactive and offer solutions, and always be prepared. So I have one of my more junior associates. I mean, he's unbelievably prepared. He always offers solutions, and they may or may not be the right one, but at least he's creatively thinking. And like 90% of the time, it's a great idea, and we take his advice. But he's just thinking outside the box. But I think you have to be engaged. So you always have to be trying to figure out how you can insert yourself into a process and learn, and not be intrusive, but always manage the two, be learning and making sure you're part of the team and letting people do, or just doing your job, but also being a part of the team.
Yeah. I love what you were talking about with the being proactive and offering solutions. I remember telling a guy that was on my team 100 years ago who would just complain about what was wrong. And my problem identification is not a compensatable skill. Bring me an idea on how to solve that, and you have my full attention. And it's because it can be easy to complain, but when you see a young person, or younger in their career, I should say, who really is trying, and they're, as you say, being proactive, and hey, I was thinking about this, and this may be a great idea. It may not be a great idea, but I wanted to bring it to you and get your thoughts. Oh my gosh, I have unlimited appetite for that.
Yeah, the other thing I would say is that, I mean, I do think in early stages of career, like, you really need to make sure you're tethering yourself to the right, boss, but mentor, because your perception as a more junior person is always going to be associated with the person you work for. And so that's why it's so important to do your due diligence and make sure that you're signing on to something that you want to be a part of, as opposed to taking something just because it's X number of dollars versus the other offer that was 10% below that, because you need to think about what it means for your longevity as from, and from a respect internally, because most of the time, who you work for is going to determine what your pay is.
Good point. So I read a stat, and I think it's pretty well known, but just saying that people don't quit companies, they quit bosses. And so, what you're saying, which I think is just really spot on advice, is you're also interviewing the boss. And is this somebody that you want to get invested in, who will invest in you? And then what you're saying about you're tethered to other people and being part of a team and a group, and just all really good advice. Karen, this has been awesome. I knew you were amazing as an analyst, but as we've kind of gone through some of these different topics, even more respect for everything that you know about the industry. I know the people who listen to this are going to benefit greatly. And I really enjoyed this last little bit on career. You had some very insightful perspectives that, like I said, I know that our audience is really going to appreciate. So thank you so much.
No, thanks very much for having me. And I look forward to seeing it go live.
Yeah, it'll be up soon enough. And again, congratulations on your new role at Credit Suisse. They're very, very fortunate to have you.
Thank you.
Awesome.
Good to see you. Okay.
Well, thank you, everybody, for listening. And we look forward to our next episode of Career Club Live, when we've got Jared Schreiber, who is one of the founders of Numerator and has recently written a book called Breakout Brands that I know people are going to enjoy quite a bit. So with that, thank you very much, and we'll see you guys next time. Bye-bye.
Thanks. Bye.